Friday, February 26, 2021, Maneco 64, home of alternative economics and contrarian views. Today we're going to look at yield curve control and what it is and why I think it will fail in the 21st century. Before I go further though, I like to reiterate that in my opinion, holding physical gold and silver is the best way also not to be shaken out of volatility in the paper markets. And why is that? Well, there are many reasons. One of the reasons why it's so is because it's a lot harder to sell your physical and your gold than doing it on the screen, getting rid of an ETF or a futures or even a mining stock for that matter. And I think the most important one, though, point why it's a lot harder to get rid of it, and you will only know that by actually buying your first gold coin, silver coin, or bar, is actually holding it and seeing how precious it is, and thinking, would you really want to get rid of this monetary asset that has no counterparty risk when the world is going to hell in a handbasket like it is now? I mean, I did a live stream last night about what's happening in the bond market. I recommend you watch that if you haven't watched it yet. Today, I'm just going to talk about yield curve control and QE because I think there's some misconceptions out there of what they are. I'm not having a go at Greg Manorino, but I listened to his video yesterday, and I think he's got yield curve control and QE slightly wrong. Maybe it's because he hasn't been in the bond markets like I have. He's more of a stock market guy. But anyway, yes, holding precious metals, holding a beautiful gold coin like the gold buffalo, for example, 1 ounce gold buffalo coin from the United States here. I bought that. This is a 2008 one, so I've had this for a very long time. I think I have some 2007 as well. Yeah, by holding something like that, you realize how precious and valuable it is instead of just focusing on paper prices like we do a lot. And yes, wanted to say that before we start on yield curve control. Right now, there's a lot of talk about yield curve control. I think they've been talking about it since last year, maybe a little longer. And what do I think yield curve control is in terms of the bigger picture? Well, I think it shows that the central bank and the Treasury are losing control of the bond market, even with massive QE. And what is QE? Well, QE is when the central bank creates reserves out of thin air. And reserves is basically money for us. When we get reserves in our bank checking accounts, it's called money. But for the Federal Reserve, it's called reserves, not money. And they create that out of thin air to buy short-term to longer-term bonds. It can be from, I guess, T-bills all the way up to 30-year bonds. And they buy that trying to keep the market, rates low to keep the economy, the credit boom going. They also do it to mortgage-backed securities, mortgage bonds. They've been buying mortgage-backed securities and treasuries since the '08 crisis. It was a housing crisis after all. And that's QE. So the Fed's balance sheet has gone from around 800 billion before the '08 crisis. It's now almost up to 7.6 trillion. Just saw the new numbers last night. And prior to March last year, it was around 3.5. So, or maybe a little more. So it's almost doubled anyway. But now, Uncle Sam, the fiscal policy, the weak economy, which they only have themselves to blame for locking down economies, for shutting the economy off. I think it's all being hyped up. Of course, this crisis that we've had. I've said that I think it's like a non-energy crisis of the 70s. And if you don't know what I mean, look up The Non-Energy Crisis by Lindsay Williams. I have the book on my shelf, but look it up. And I said already last year, this is going to be like that, engineered. But anyway, yes, the market is starting to show that even with 120 billion QE a month, investors are losing faith and confidence in the Treasury and the Fed that they're ever going to be able to rein down this monetary and fiscal stimulus. So why do I think yield curve control will not work this time around, or they'll have a very tough time? Well, we need to first look at what it is. So I'm going to go through an article that I've gone through already a few months ago about yield curve control. It's a very good article that shows you what yield curve control is. Yield curve control is not QE. So this is actually from the Brookings Institute. What is yield curve control? So we'll go through this. And it says, editor's note, this post was originally published on August 14th, 2019 and has been updated on June 5th, 2020. So yeah, they've been talking about it for a couple of years almost. It says the Federal Reserve is considering the monetary tools it will use to bolster the economic recovery from CV. The Fed has already reduced interest rates to near zero and used two tools it deployed during the Great Recession: forward guidance and quantitative easing, or QE. So you see, not the same as QE. In addition to these, Fed officials are now talking about yield curve control, sometimes called interest rate caps. Here's an introduction to yield curve control and how it might work in the United States. What is yield curve control and why does it matter? It says in normal times, the Fed steers the economy by raising or lowering very short-term interest rates. There you go. The Fed funds doesn't need QE. And that's what Greg Mannarino said yesterday, that QE is used to keep Fed funds near zero. No, I disagree with that. QE is more for longer-term rates, as they say here, such as the rate that banks earn on their overnight deposits. Under yield curve control, YCC, the Fed would target some longer-term rates and pledge to buy enough long-term bonds to keep the rate from rising above its target. So it's a pledge, it's not QE. This would be one way for the Fed to stimulate the economy if bringing short-term rates to zero isn't enough. Prior to the COVID-19 crisis, current Fed governors Richard Clarida and Lael Brainard, as well as former Fed chairs Ben Bernanke and Janet Yellen, said the Fed ought to consider adopting YCC when short-term rates fall to zero. Yes, and they are also doing QE on longer-term rates, but I think they want to show the market that they're not going to be doing QE forever, and that's why they need to bring out this yield curve control. They're concerned that raising the balance sheet to 10 trillion, 15 trillion would look really bad for the dollar. New York Fed President John Williams has said that the Federal Open Market Committee, FOMC, is thinking very hard about whether it might use YCC this year. Other members of the FOMC have also said they think it could help strengthen the Fed's forward guidance. Well, forward guidance is just telling the market, like they're doing right now, that they're going to keep rates near zero for the next 3-4 years. It's just telling the market what they're planning to do, which currently says that rates will remain near zero until the committee is confident that the economy has weathered recent events and is on track to achieve its maximum employment and price stability goals. So much for price stability. Australia's central bank adopted a form of YCC in March 2020 in response to the CV and is targeting a 3-year government bond yield of 0.25%. Yield curve control is different in one major respect from QE. The trillions of dollars in bond buying that the Fed pursued during the Great Recession and is pursuing in 2020 and 2021 now. QE deals in quantities of bonds. YCC focuses on prices of bonds. Under QE, a central bank might announce that it plans to purchase, for instance, $1 trillion in Treasury securities. Because bond prices are inversely related to their yields, buying bonds and pushing up their price leads to lower long-term rates. So here's the difference now. Under YCC, the central bank commits to buy whatever amount of bonds the market wants to supply at its target price. Once bond markets internalize the central bank's commitment, the target price becomes the market price. Who would be willing to sell the bond to a private investor for less than they could get by selling to the Fed? The Bank of Japan, BOJ, committed in 2016 to peg yields on a 10-year JGB, Japanese government bond, around 0% in a fight to boost persistently low inflation. Even the Brookings Institute doesn't know the definition of inflation, right? Because creating money and credit or reserves and credit is inflation itself, right? To hit that yield target, the BOJ has a standing offer to purchase any outstanding bond at a price consistent with the target yield. On days when private investors, for any reason, are less willing to pay that price, the BOJ ends up purchasing more bonds in order to keep yields inside the target price range. The Fed had some experience with interest rate pegs, or YCC, during and after World War II, when the Treasury needed help financing wartime expenditures. In 1942, the Fed and the Treasury internally agreed that the Fed would cap the Treasury's borrowing costs by buying any government bond that yielded above a certain level. At the time, around 0.5% on 3-month Treasury bills and 2.5% on long-term bonds. Until 1947, the Fed was able to maintain these pegs without having to buy up large amounts of bonds. While it would now be considered inappropriate for the Fed to explicitly reduce borrowing costs for the federal government, that experience demonstrates that the Fed could be successful in targeting medium and longer term rates through purchases. In fact, the Fed staff studied potential unconventional policy options to reduce long-term rates in 2008. They look back on this experience as evidence that asset purchases on a similar policy could work. I'll come in here now and say why I don't think it would work this time. Well, back in that period when they did yield curve control successfully, the United States was at war. And a little bit after the war, 42 to 47. But more importantly, the United States was the biggest creditor nation in the world. So, as you can see here, the United States had the most gold up until around that time, late 40s, early 50s. So it was the biggest creditor nation in the world. Most of the borrowing Uncle Sam or the Treasury had to do, it was done via private investors, not just private, but I mean domestic investors. I think there was a lot of capital controls as well. The financial markets weren't as open and global as they are now. And the other thing I would say now, the United States is the biggest debtor nation out there. And I think I think it was Pierre Lassonde, I listened to his interview on King World News. He said that Taiwan, the People's Republic of China, which is communist China, Japan, and South Korea, they've got 6 trillion in dollar reserves. So, and there are other big creditor nations as well to the U.S. And why do I think it would be hard for them to really maintain this yield curve control now? Well, because I think foreigners would feel hard done by, shortchanged, especially seeing how commodities are going up, how everything's going up, how the Treasury and the Fed are stimulating things so much. You know, they don't want to keep a hold of a currency that is losing value very quickly. They might not get rid of all their treasuries, but they will definitely think about not holding 6 trillion, maybe holding 3 trillion, and buying other things with it, and be whatever they want. Could be gold, could be silver, could be commodities, stockpiling commodities, could be other assets. But that's why I don't think it would work. Yes, they could institute it, and it might actually they might actually be able to keep those pegs, but I think they'd have to use a lot of QE, because I think there would be a lot of people would test those pegs very regularly. So that's why I think we're in a completely different world, because finance is like global right now. Capital flows are like very quick. Back then it was different, a different world. They could keep domestic investors under the thumb with the yield curve control, because they didn't have any options. They're not going to go buy bonds from other countries back then, but nowadays they can. So let's continue anyway, because they want to look at what happened with the Bank of Japan. It says, what do we learn from the Bank of Japan's use of yield curve control? It says the BOJ is the only major central bank to have experimented with interest rate pegs in recent history. YCC is just one piece of the BOJ's large policy effort that also includes QE, forward guidance, and negative interest rates. And it's all worked really well, right? Not. All aimed at lifting inflation. The bank has been successful at maintaining a yield of 0% on JGBs. The JGB yield, the 10-year, is actually positive now. It's actually at 0.16%, and it's even up 2 basis points today. So it looks like even Japan is kind of failing at that. So let's continue. In addition, YCC has allowed the BOJ to purchase fewer bonds in the last 3 years than it did under the large QE program that began in 2013. Until late 2016, the BOJ was purchasing about 100 trillion yen in JGBs each year. As a result, the BOJ's balance sheet expanded much faster than that of other major central banks. So yeah, that's what I said earlier. You know, when people start getting uncomfortable about the balance sheet going up so much QE, they think about yield curve control, right? Since the initiation of YCC, however, BOJ has purchased government bonds at a slower pace and still kept yields on 10-year bonds historically low levels. So far in 2020, the bank is on track to purchase only about 6 trillion yen of government bonds, and has been able to respond to the C disease downturn by greatly expanding its purchase of other kinds of assets, including corporate bonds and equities. The BOJ experience demonstrates that credible YCC policy can be more sustainable for central banks than a quantity-based asset purchase program. That's QE, asset purchase. How would YCC affect the economy? Interest rate pegs theoretically should affect financial conditions and the economy in many of the same ways as traditional monetary policy. Lower interest rates on Treasury securities would feed through to lower interest rates on mortgages, car loans, and corporate debt, as well as high stock prices and the cheap dollar. All these changes help encourage spending and investment by business and households. Not too sure about that. Maybe households more than businesses. Recent research suggests that pinning medium-term rates to a low level once the Fed funds rate hits zero would help the economy recover faster after a recession. So right now, even short-term rates are starting to rise. And the one thing that Greg Manarino said that I agree with, if they're going to do the yield curve control, it will not just have to be for longer term or medium term rates. It could be for the whole yield curve. They'll have a really tough job, I think, controlling this. It's going to defeat the purpose, I think, of trying to rein in a little bit of their QE and increasing their balance sheet. I'm going to skip some of this article here. I'll put a link to it down in the description box below. You can read the whole thing. I don't want to go, it's a fairly long article, but it says here in the conclusion, in short, YCC might be a promising tool to support the recovery from CV, but only if the Fed can achieve a smooth and credible, there you go, credible implementation of the policy. So I think it's still very much up in the air. Let's look at where the markets are this morning. It's 8:18 a.m. London time. We got spot gold at 1761. That's down 9. The range has been 1776 to 1755. Silver has dropped further today. It's not performing as well yesterday, but we're still around 27. So that, for me, that's still quite positive. The longer term picture still looks good. We're at 26.87 right now, down 54 cents. High's been 27.63, low has been 26.73. The Dow future is down 66. NASDAQ down 12, S&P down 2, but they've been down a lot more. I think it's been down as much as 200 points to Dow. The NASDAQ has been down as much as 150 overnight, and the S&P has been down as much as 20 points. So things are still very rocky and volatile right now. The currencies, yes, we're starting to see the pound reverse back. And I always thought the move up in the pound was weird. I'm not surprised it's getting hit so hard since yesterday. We're now almost back to 139 after almost getting up to 142. It's down about 2/3% at 139.28. The euro is down 0.2% at 121.50. The dollar is down slightly versus the yen at 106.07. Dollar's down 1/3% versus the yuan at 646.80. Copper down about 1.3% at 420. Do I think the bull market in commodities is over? No, I think we're just beginning. And I've said in the past that these markets don't go up in a straight line, and you get shakeouts and corrections like we're getting right now. WTI crude is down 1% at 62.78. And now to the bond market, to Treasury yields. Where are we this morning? Well, yeah, we've come off a little bit here. The 10-year yield is back below 150. It's at 149, down about 2.5 basis points. The 30-year is down about 3 at 228. What about the 5-year? 5-year rose a lot yesterday as well. So did the 7-year. Right now, the 5-year note is at 0.78, or down about 2.5 basis points. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Facebook, Twitter, and all these other platforms below here. So I wish you all a great weekend. Take care. Bye.